Okay, I think we'll get started now. Again, this is Adam Goldstein from the Federal Home Loan Bank. Good morning. Happy spring. Hope everyone's having a nice day, staying healthy. Thank you for joining us for today's webinar presented by our friend Scott Hildenbrand, Managing Director and Head of Balance Sheet Analysis and Strategy at Piper Sandler. Scott was on the program last year, one of the highest rating, if not the highest rated speakers that we had in our webinar series out of 20 webinars that we did last year. I'm friends with Scott, so I joked with him and said, I don't know why yours that highly rated, but you will find out very shortly. Scott always does a wonderful job and very, very sought after by our membership to come talk about what's happening in the market. We'll continue to bring you these sessions. We're striving for every other Thursday, hosting a range of speakers from the Home Loan Bank or outside speakers to cover the most important topics of the day. Our next session will be on LIBOR transition with the title Fourth Quarter or Overtime. That will be presented by our staff, Ray Shinazuka, who's our Vice President, Director of Capital Markets Research. He also heads our LIBOR transition team internally at the Federal Home Loan Bank, as well as someone you know, Tom Citino, Vice President, Director of Member Relations. That will be on Thursday, April 22nd. Same time, same place. We are also working on future programs that are getting a little bit more into fintech and crypto and payments and the Fed. So we have an exciting lineup. Although we'd much rather see you all in person at regular meetings, while we're still in this environment, we're going to try to do our best to bring you the most relevant content to help you run your businesses. A couple important announcements before we get started. Just as a reminder, we did, along with working with our board of directors, create a pathway to more dividend income through our letter of credit program. So now you're able to purchase capital stock with those letters of credit. Very helpful. I mentioned in previous sessions that we launched our mortgage asset program to replace our MPF program. That is going along very, very well. A lot of our members transferred over. If you were, because we are no longer offering MPF in MPF, or want to get a line set up for selling loans to the Home Loan Bank, just let your relationship manager know. Be happy to set that up for you. For those of you who are members of IBANYs, Independent Bankers of New York, their conference, April 19th, we'll be giving a presentation there with our chief economist and Tom and Muriel Brunken, talking about the state of the housing market and the FHLBNY's new mortgage program. If you're calling in from the Caribbean region, there's still some excess funding for a small business recovery grant. The New York, New Jersey allocations are out. If you are on that waiting list, we are doing our best to look at first quarter income, look at our budget to see if we're able to fund some of the members that are on that waiting list. So stay tuned. We obviously, if we can, we will, and you'll hear from your relationship manager shortly on that. Last month, we sent out the notices about the RSA devices. So we sent out about 1,500, and only a couple hundred have been activated. So we very much encourage you to activate your RSA device. If you have any questions on that, or if you have not received one, just let us know. I also want to mention the final announcement that, now that we're into April, April is Financial Literacy Month, as I'm sure you all know. And we're doing our best to partner with our members on presentations, usually in the schools, but this is obviously a different environment. But if you're doing anything in your local school districts and the Home Loan Bank can help, we have presentations ready to go that can help you out. We're also using the month as an opportunity to engage our regulators. I think I mentioned this 2 weeks ago, but we have a pretty robust regulatory outreach program with all of your regulators. And if there are any topics that you would like to for us to raise on your behalf, of course, names aside, let us know. This Friday, we have the Federal Reserve. On April 12th, Department of Financial Services. On April 14th, the FDIC. On April 15th, the OCC. On April 19th, NCUA New York. On April 21st, NCUA New Jersey. And on April 27th, New Jersey Department of Banking and Insurance. We're also working on scheduling meetings in April for our regulators in the Caribbean District and the Lieutenant Governor in the Virgin Islands. So we have a robust agenda of things to talk about with them, but anything that's on your mind, just let us know. Just call me directly or ask your relationship manager, and we'll be happy to ask anything that is on your mind. Okay, with those announcements out of the way, I want to hand it over to Tom Citino for introductions. But before I do, just a reminder, if you have any questions, please submit them at any time through the question box, and we're going to answer them in a Q&A session at the end. And as always, we want to make sure these programs fit your needs. So there'll be a survey, and we really request for your feedback in the survey. Let us know what topics you want to cover for future sessions. So now I'd like to introduce Tom Citino, Vice President, Director of Member Relations, to find out very shortly. Scott always does a wonderful job. Thank you all for attending, and everybody be safe. Thank you. Tom?
All right. Thank you, Adam. Good morning, everybody. It's really a pleasure to introduce Scott Hildenbrand. I've known Scott for a number of years now, probably 5 or 6 years, and I've seen him speak at many different events, and he's always has a lot of thought-provoking ideas to discuss, and I believe he'll have that today as well. He's the Managing Director and Head of Balance Sheet Analysis and Strategy in the Financial Services Group at Piper Sandler, and he also runs Piper Sandler's hedging services as well. But in his work at the firm, he works with financial institutions, depository institutions nationwide, and he consults on balance sheet strategy development, which includes interest rate risk management, investment portfolio strategy, retail and wholesale funding management, capital planning, budgeting, and he also consults on stress testing as well. He also works closely with Piper Sandler's investment banking group to identify and develop strategic opportunities for clients who are involved in M&A. But prior to starting at Sandler in 2004, he started at Sandler in 2004 working in the ALM group, and he proceeded to move on to different
range of speakers from
advising. But prior to that, he was an ALM person at a credit union. So with that, Scott, I'm going to turn it over to you, and we're going to discuss how we can best prepare for the rest of 2021. So Scott, take it away.
Well, thank you, Tom, and Adam as well. And as Adam mentioned, he's a friend, and I think the reason I even got decent reviews is because he lets my mother and father vote for me. But Adam and Tom, first of all, thanks for having me. Alyssa, thanks for helping me get set up. And to everybody at the Home Loan Bank New York membership, appreciate the time today, and hopefully make it productive. And look, I think right from the beginning, and I'll hopefully share my screen okay here. My title is "You Can't Predict, but You Can Prepare," and I remember reading that from Howard Marks probably almost 20 years ago now, and that has really stuck with me as I think about asset liability, balance sheet management. And it serves me pretty well. I think a lot of people sometimes can twist themselves a little bit in the pretzel trying to predict instead of just preparing, right? And whether it's a flatter curve, a steeper curve, higher rates, lower rates, our job as balance sheet strategists, as asset liability managers, is making sure that changes in rates will never dramatically shift the earnings stream. And so with that, that's kind of the core of almost anything I do as it relates to balance sheet management. And that's really going to be the sort of the foundation of what we'll get into today. But with that, let's get started here. Let's see, here we go. All right, so what I thought I'd do today is do a little bit of themes. If you've ever heard me speak before, I always love to start very broad, talk a little bit about, what I'm seeing on banking balance sheets, banks, credit unions, thrifts, savings institutions. There's about 1,000 or so that come through my group a year. And so I learned a long time ago, I wouldn't win an IQ test on this call or any speaking engagement I give, but I have an advantage, right? I'm in so many ALCO and boardrooms. I spend time with regulatory world, and I spend time with investors and bank stocks. And that gives me a lot of information, just from the questions, the issues, the opportunities, the exposures that I get to see. And so my job today is going to be talking a little bit about all those things that I'm seeing, the questions I'm getting, and hopefully help you out and give you some ideas around maybe some strategies or some tactics that may make some sense. So look, I sort of do my top 10 list or my top 4 list, and I tell you the number one question, it's probably been in my nerdy world for the last 12 months, the word liquidity comes up in pretty much every single balance sheet discussion I have, right? And, I kind of give you the quick bullets of it is still here, right? And in fact, it continues to grow. And it's interesting, liquidity is always sort of like interest rates. Interest rate risk in some people's minds are always viewed as higher interest rates is something we need to worry about. And I've always viewed it as lower interest rates, higher interest rates, flatter curve, steeper curve. that matters to me. Same in the liquidity world, right? You can often think about it from a regulatory perspective as liquidity is not having enough dollars, right? Not having enough funding. But I'd argue sometimes you can have too much liquidity. And I think we're all sort of suffering through that a little bit. It might be a higher class problem, but it's still here. And, you know, the reason I bring it up is because I hope no one's offended by the comment, but I really truly go back to my core of thinking. I think it'd be fool's gold to think that we woke up a year ago and all of a sudden became much better at gathering deposits, capturing deposits than we were previous to the pandemic, right? And I think we all understand that the stimulus, triple P, lower interest rates, everything under the sun has been prepaid. Governments bought every asset that wasn't nailed down. It's all led to a tremendous amount of liquidity in our industry. But the question I always have, and one of the top 5 questions I ask every board and every ALCO member that I spend time with, is how do you strategically measure your liquidity, right? Because I'll tell you one thing that's not going to work is leaving your cash position at 12% of assets. You know, that might work for 3 months. That's not going to work for 6 months, and certainly not going to work for the 12 months since we've really started to see a ramp up. So you need to have a plan. And you know, and I'm a huge fan of the Federal Home Loan Bank, certainly New York. And one of those reasons is that they're here for the good and the bad. They're there for us. So what I always say is if you know, when I think about strategically measuring my liquidity, I would have a policy and a number around cash and unencumbered securities as a percentage of assets. And that should be optimized and thought of and determined as your strategic measure of liquidity. I often joke, and I think I'm right about this. If I polled, you know, 15 CEOs and pulled them into a room and I said to he or she, how do you measure liquidity strategically? I might get 41 different answers, right? And I think that's a problem.
The most relevant content to help you run your
really focus on in that ALCO meeting so that we can start thinking about dollars that we can put to work, what we look like, and what we look like in times like today, and then in times like 2 years ago when we were fighting tooth and nail for the next deposit to get in. So obviously liquidity is leading to margin pressure across the board. It's been really interesting, and I got a slide in here that I'll get to in a minute, to kind of take a look at what your asset mix has done over the last 12 months. Then I'm going to compare it a little bit to what we've seen in other times of increased liquidity throughout the industry. One other point I want to bring up, and people always give me an odd look, and I think it's because of my background originally at Sandler O'Neill and now at Piper Sandler, you know, in the M&A world. I am a huge believer that the #1 driver of cost of funds specifically in the deposit world is not the Fed. It's not the Fed funds rate, but it is the M&A world. And I think a lot of people think I'm crazy when I say that, but I've always been a believer that M&A is a leading indicator of where deposit pricing will go. Because what you will see in most M&A deals that I've ever worked on, and I've worked on tiny ones, and I actually worked on when Ameritrade sold to Schwab, and everything in those deals were designed around the deposit base. So when you start to see deals ramping up, you're going to start to notice that more and more institutions looking for scale, looking for non-market money, right, deposits. And I've always been a firm believer in start graphing 2 things when you're thinking about in your ALCO meeting, thinking about where your cost of funds are going. M&A in your market, it would be #1 driver, and #2, your top 10 competitors' loan to deposit ratios. I always make the joke in ALCO that we're so selfish, right? And I go into these ALCO meetings and we don't even talk about our competition. We just talk about our own balance sheet. We need to understand the pressures that our competition's facing. And by the way, our competition's different than probably even where it was a year ago, 2 years ago. Community banking isn't going anywhere. I just think the definition of community is going to be different. Virtual plays a much different role than it did 10, 15 years ago. So again, M&A is a big driver. Pay attention to deposit premiums. And I'll give you a really good example of something I'm keeping an eye on. And I always have these weird thought process, but I like to share them with everybody. You know, back in 2015, so early 2015, so we announced a deal, PacWest bought Square One down in Raleigh, North Carolina. And they did the deal, and everybody kind of looked at it because the deal was really done to purchase a ton of deposits. You know, PacWest out in California buying a bank out in Raleigh, North Carolina, and there was a lot of underlying reasons for it. But the #1 driver is Square One was a fantastic deposit gatherer. But at the time, everybody kind of looked at it as the deal was announced, and the deal was announced as not even accretive to earnings. And why I bring that up in a liquidity discussion is because they might have been a little bit early, but that was the beginning, in my mind, of the cost of funds and cost of deposits starting to change. Well, fast forward, here we are in early 21, and PacWest again out in California announced a deal last week where they bought I believe it's the homeowners association type deposits from Union Bank out there, and a $4 billion deposits they purchased. Went out and got that. When everybody's kind of choking on deposits and funding, they went out and bought it again, now more, backing up the truck and bringing it in. So again, I keep an eye on things like that because I do think it's probably early, but please pay attention and don't fall asleep and lull into just we're always going to constantly have this liquidity. And I'm going to give you some ideas about how to deploy it in a minute, but I want to give you that thought process around M&A and loan to deposit ratios as I think about liquidity. The second topic, and it is marching up and it's right behind liquidity, is the yield curve.
Just let your relationship manager know.
And especially when I get questions from investors in bank stocks, but we actually have a yield curve, right? Steepness is here. My question to almost every single institution,
Happy to set that up for you.
You know what I'm going to say. I love interest rate risk. I love balance sheet strategy. I hate parallel shifts and creating balance sheet strategy. And the reason I bring that up is because every institution, I don't care what your asset size is, needs to answer a question. And that question is, what part of the yield curve matters most to your institution? When I ask that question to board members, to ALCO members, to senior management, I don't get great answers all the time. And if I was ever on a board of a bank, running an institution, that would be something I would be obsessed with and understand, because I'll tell you why. 10-year Treasury has doubled in a matter of months, more than doubled, right? We're up over 100 basis points from the lows. And yet, I'll tell you, most institutions haven't felt a lot of benefit, yet they continue to tell me that they're asset sensitive. So you need to know, are you pegged to the short part of the yield curve? And if you are, you're exposed and waiting for the Fed, and this move in interest rates higher, you're really not seeing a ton of benefit. So I often put the question out, what are you even rooting for? And investors will call and say, hey, Scott, isn't it great? 2s and 10s, right? The 2s and 10s spread on the Treasury curve traditionally was, for bond managers, the ability to say, okay, that's a steep or flat yield curve. And while the math works, and 2s and 10s are great, I think we're 150 or so basis points. You know where most institutions are impacted is based on the spread between Fed funds and 5s. And so in your ALCO meetings, and I get the 300 basis point parallel shift, and I know why we're doing that. But from a strategic perspective, take a hard look at the spread between Fed funds and 5-year. That'll be a better indicator of where margins are going. And I often tell investors in bank stocks to pay attention more to that than to 2s and 10s. The other comment I have here, when you see the end of March numbers and you look at your bond portfolio, guess what? It's rearing its ugly head again. We had to buy, and this is classic financial institution, bank, credit union, savings institutions, right? When do we buy bonds? Not when we think interest rates are incredibly high and spreads are incredibly wide. We buy them because it's a supply demand. We buy at all-time or near all-time lows in rates. Economy had slowed down. Loan demand is modest at best. That's when we buy bonds. So anytime you see a movement in the yield curve, guess what you're going to see? You're going to see mark-to-market issues. People are going to ask you around other comprehensive income. Why aren't you using held to maturity? I am still blown away to this day, and almost every institution I go into, there is a board member at that institution that somehow knows exactly where interest rates are going at all times. And it blows my mind. So we need to be prepared for this comment and this topic around the bond portfolio, the mark-to-market risk that it has, and whether we even need to care or not. So I'm going to go through, and I created a little bit of a decision tree for you that I'll walk you through in a moment. Third here on my list is capital. And really, it's been in the debt market most. The debt market remains wide open. And if you think about it, it makes a lot of sense. If you're out there trying to raise money right now, guess what there's a lot of? Cash. And people like insurance companies, banks, money managers are dying to invest in institutions like yourself for 5 years, 10 years, 4%, 350, 4.5%, 5%, depending on the credit. Spreads are still tight. We're still getting deals done starting with 3 handles sometimes, even though we've seen 10-year Treasury ramp up over 100 basis points. The only thing I'll say here on the capital world and the debt world is, a lot of us have bought sub debt and put it into our bond portfolio. I wrote a piece, I don't know, maybe a year ago now, around how I would design my investment policy to be able to include and underwrite and understand purchasing sub debt and adding it to the bond portfolio. Examiners are aware of it. They've given you a hard guideline on how much you can own. But all I will tell you is that all sub debt is not created equal. It is not underwritten equally. Pay attention to who's underwriting. Make sure they know the market. I've heard horror stories of some institutions buying a sub debt piece and then needing to sell it 3 months later and massively underwater when interest rates went actually lower and credit was fine. So pay attention to who you're buying from. It's really important. And if you ever want to see the white paper I wrote on sub debt, shoot me a note and I'll send it out. Finally, M&A, and I believe Tom told me you had a great presentation, I think a couple weeks ago on M&A, so I won't bore you. Deals have started. You're seeing it. And a lot of it has to do with currency, right? Where does your stock trading these days? And there's better multiples for the larger banks. And so you're going to see bigger deals, MOE type deals, and a lot of this is tech and scale, as it's been in the past. And so you've got a lot of things going and moving in the direction of the M&A world. And don't forget my connection between M&A and liquidity. Okay, this is admittedly not my slide. This is slide 3 here, and it says you can't predict, you can prepare. And so someone on my team is actually an economist. And, it's really interesting. We have really good debates and discussions because he's smart enough to understand economy and the economy and being called an economist. He's literally a PhD, and I can't spell PhD. And yet we come about asset liability and balance sheet strategy at the same place. And that is, you can't predict, but you can prepare. And what I often make him do is I make him tell me why the Treasury curve will rally and why it could sell off. And if you're not preparing for both of those, I think it's a huge mistake. And the other thing that I often say is, and again, this is for the board member or the senior management member, and Adam and Tom and I were just joking that as much as I pound the table on not predicting where interest rates are going, and in fact, I'd argue my job is to make sure I never do, there is someone at every institution trying to predict where interest rates are going. I can give you rational reasons why Treasury rates will rally, prices higher, yields down, or I can give you the opposite argument. What does that tell me? It actually tells me that I need to be prepared for shape of yield curve changing steeper or flatter. And I'm not going to wait for 100 basis point moves. If you don't have a strategy in place for a 15 to 20 basis point steepening and a 15 to 20 basis point flattening, you're not doing your job at Alco. And I'm going to give you some ideas around what those are, but I included this slide in here because I get the question all the time, hey, Scott, where are rates going? And I'm smart enough to know I have no idea, but I do have a team of people that are really smart on this topic. So take a look at his points here on why you could see the Treasury curve rallying or you could see it selling off. This is my slide. This is very simplistic and more in Scott's realm of how do I think about the market, right? What is the yield curve giving me today? And this again goes back to parts of the yield curve that matter most to your institution, right? Take a look at March 31st, 2020. There was no difference between Fed funds and really the 5-year part of the curve. There was a spread of 13 basis points. Let's see if I can highlight it here for you, right? And 2s and 10s even were at 42 basis points. Fast forward, pick a time, and really you saw no spread improvement in the 5-year, the Fed funds in 5-year. Fast forward to where we are today, yesterday, April 7th of 21, and now look at the 2 years in the 15 basis point range, the 5 years at 85, 7s and 10s, you can see the steepening, and now in 2s and 10s you have 150 basis points. And you've got 60 basis points in Fed funds in 5. And I wish I was in the room with everybody because I'd make you raise your hands and say, how many of you, when you manage your asset liability meetings, talk about Fed funds in 5-year expanding 15 basis points or compressing 15 basis points, and what is your strategy? Or said better, how much exposure do you really have to the 10-year part of the curve? How many asset sensitive institutions out there are seeing margin expansion because the 10-year treasury has steepened out? I'm going to bet not enough of us. A lot of us, the commercial institutions, the commercial banks, are tied to the short part of the yield curve. And so you've seen no relief and no benefit yet given the rate move. So prepare your board, prepare your ALCO for understanding part of the yield curve that matters most to you, and then create, whether it's Fed funds and 5, maybe it is 2s and 10s, that's the spread that matters most to you. But you should have the strategies designed around that part of the movement of the curve. And don't wait for the 100 basis point move, right? We went from 13 to 69 at one point on Fed funds to 5. I hope there was strategy deployments. And a lot of the institutions I work with, and I started an advisory practice out of Sandler O'Neill, now out of Piper Sandler, where we do run your ALCO and come in and help you work through strategies based on things like this. So again, you can see the spread movements. Okay, slide 5 here is something that I've been finding really interesting, and it's a lagging, not a leading. So I don't want to put too much emphasis on it. But one thing that I find really interesting is a lot more institutions today are sitting in cash than ever before. Yet, when you go back and think about liquidity into the industry, right? And you go back to 2012, 2013, I love looking at the US personal savings rate, right? As a percent
We have a pretty real
of disposable personal income. And take a look at my graph here down at the bottom. The average has been somewhere around, let's call it 7% of disposable income. Currently, we're at 13.5, 13.7. And obviously, we saw a major spike at the end of April a year ago at 33%. That was for obvious reasons. But what I thought was interesting is in December 31st of 12, we hit 12%. That's not that far from where we are today. Yet when I think about your cash allocation, and I go back to December 13, right? You were at 5.5%. When at the fourth quarter of 20, you're at almost 10%. And so for me, this is something I'd be paying attention to. One, to see what I looked like 5, 6, 7 years ago when we were not the same situation, but we did have a lot more liquidity. I remember banks telling me back then that they couldn't turn the faucet off for deposits coming in, yet they were comfortable enough realizing that they couldn't lend it out, but they had to buy assets. Yet because of where the overall nominal interest rates are and how fast cash came in, we've had a tough time. I've had a lot of institutions sitting on the sidelines waiting for interest rates to get better. And there's a very simple math equation that you can run to show you break even or a break-even analysis of investing and staying in cash versus investing in the bond portfolio. And to me, and this is a plug for the Federal Home Loan Bank, because they'll be with us through thick and thin. So to me, I have never thought of liquidity as having dollars in hand. It's the ability to raise cash quickly and efficiently. So if we're buying securities, right, and that securities as a percentage of assets is going higher, right? That's okay as long as a lot of those assets are pledgeable, number one. And number two, I think a lot of us sit here in fear and worried about a mark-to-market risk of our bond portfolio. And I got to tell you, from at least a valuation perspective, bank stocks trade at their highest when their bond portfolios are valued at their lowest. So if you're
on April 15th,
because tomorrow interest rates might go up 25 basis points, I think you've got it completely wrong. Your bond portfolio is supposed to be your front line in any war of any movement of interest rate risk. And yet everybody treats it like it's their savior. And in fact, it should be their front lines. That's where you should be taking duration if you need it. That's where you should be shortening up duration if you need to do it, depending on what it is. But you should always be fully vested, but just be prepared to understand how you strategically measure your liquidity. So pay attention to this personal savings as a percentage of disposable personal income. And I challenge you to look at your own balance sheet and go back a few years and see what you look like. I'm going to bet you never got to cash positions like you have today. So naturally the question is, all right, Scott, you're so smart or think you're so smart. What the heck are you supposed to buy in a world where I'm competing against everybody, including the Fed, right? The Fed buys the same bonds we buy. And so a couple of points I wanted to point out here, and I run this every week, or my team does. I don't actually do any work, as everybody who knows me know, but my team runs every week. We upload any asset that an institution would ever think about buying and comparing it to the treasury curve. And you can see here in blue, here's the treasury curve. We actually have some steepness, as we talked about. And then you can see all the different assets that we in theory could buy and the spread above treasuries. I tell you this, and it's important to think about, the steeper yield curve creates value in roll down. And I've always said, right, I like predictable cash flows. I think we just went through a really tough environment where a lot of you have a black eye because we bought pass-throughs or CMOs that came ripping in because we saw major moves in interest rates, right? And so the steeper yield curve has to have you thinking about getting some positive convexity. If I buy a 7-year asset, I want to know 2 years from now it's going to be a 5-year asset. There's value to that. The problem is everybody knows there's value to that, so spreads on those assets are tight. And I'll talk about specific assets in a moment. But for the very least, at least you actually can see yields in the 160 to 2+% range in where we are in the market today. And I got to tell you, you know what the widest spread in the country is? The widest spread in the country is the difference between sitting in Fed funds at 7-8 basis points and putting it in the bond world at 1.5 to 2 to 2.25%. And so managing that and having that conversation and seeing what it looks like in the rest of your balance sheet is incredibly important. Jumbos continue to see prepay speeds really high. I think there's stimulus, obviously.
Mind, just let us know.
Which has driven municipal spreads tighter and tighter, and in fact, too expensive right now. And the other thing that's driving assets so expensive is that not only there's limited incentive to sell any assets out in the market, right? So there's a limited supply to buy because nobody who's selling an asset right now because everybody's flush with cash. You saw the ratios, and so we've got to go buy more assets, which drives spreads down. All right, so what are we buying? So if you're ever having a conversation with me in terms of what you're buying, there's plenty of assets to look at. You're not going to love spreads on almost any asset because you're competing with so many others. But where I've seen institutions leaning more into are brand new agency mortgage 20-year mortgage twos. I like 20-year twos because premiums, you can get premiums depending on the day, premiums below $103 price. That makes me feel more comfortable, and they've been originated kind of post-pandemic. The other asset classes that people typically would normally look at in today's world, munis and agency CMBS. The muni world, as I mentioned to you, has gotten so expensive. I don't care if it's taxable, which have seen a little bit more supply and you get a little bit more spread, or the non-tax, right, with the anticipation of the corporate tax rate going higher. Those spreads are, in my opinion, to use a very technical term, ridiculously tight. So what it's led to is I've seen more and more institutions shy away from munis and agency CMBS and buy some non-agency CMBS, AAAs, and really out in the 5, 7, and 10-year parts of the curve, getting 2+% yields. And when people tell me, Scott, I'm not going to buy a non-agency CMBS, it's non-agency. And I said, but you've been buying municipals. Those are non-agencies. And I look at those two in very similar thought process because they're the same type of bullet type in structure, different collateral. But I'd argue you can get your arms around a CMBS pretty quickly because a lot of us lend to the same in the same sector. So again, if you've got expertise at your institution, I'd be looking hard at non-agency CMBS in that 7 to 10-year part of the curve where the curve is starting to steepen out. You can get 2+% yielding assets, and it rolls down the curve nice. I continue to think there's a little bit of room for some sub debt that's out there. You got to pick and choose appropriately. And then finally, non-CUSIP investments. I've heard more and more questions around BOLI. Makes sense, right? Where we're flush with cash, tax rates going higher, non-mark-to-market assets like BOLI have really picked up. Also, loan flow programs. If I can't originate, I'm going to buy, or at least evaluate the buy programs that are out there. So all of these are really where I'm seeing people. CLOs continue to, I'd call it a very binary world. You're either in that world or you're out. And if you're in, there are some opportunities to buy some floating rate paper with decent spreads. You got to do your homework, a lot of homework, and understanding how the product works. But for some of the institutions out there that have credit expertise and can't find it in the lending world, they're carving out a small portion of that bond portfolio and treating it like a loan surrogate. Subdebt, looking at non-agency CMBS and maybe some CLOs. Okay, so now if we're buying 20-year mortgages, which is predominantly what I'd be doing in my portfolio, there's pledgeable, they're incredibly liquid, they bring a stable cash flow situation, and I'm able to kind of barbell some other assets to drive yield higher. Well, I've got to be sensitive to something. And I mentioned this in my opening comments. Tangible book value or tangible common equity ratios could see some volatility because we're buying bonds, putting them in available for sale, and watching the yield curve steepen right underneath us, right? We bought assets a year ago because we had to. None of us said we needed to or
All for attending, and everybody be safe.
Wanted to. We did it because we needed to. And it was better than sitting there earning 5 basis points or 10 basis points. But now all of a sudden, we've got bond portfolios that have grown in size, both in dollars and as percentage of assets. We need to understand the impact to the mark-to-market of the bond portfolio. And everybody I talk to when we initially get into this conversation go about it completely backwards. They say to me either, how big should my bond portfolio be? Or, hey, Scott, tell me what my duration looks like compared to all the 1,000 institutions you see come through your group. Why on earth would you do that? To me, your duration in your bond portfolio should be set by one thing. It should be set by your business model, your interest rate risk position, not by somebody else's. And so what I always say is, instead of thinking about it as what your duration should be versus peers, there should be a governor based on, take a look at your tangible common equity ratio, take interest rates up 100 basis points, tell me the mark-to-market on your available for sale portfolio, and tell me where you get uncomfortable from a tangible common equity ratio. That is a much more thoughtful way to think about where your duration risk should be based on your interest rate risk position and your governor of your tangible common equity ratio. Other things that you need to think about before you start diving into held to maturity, think about your liquidity profile. Think about accounting solutions versus economic solutions. And then I'll get into my favorite slide in a minute, bond valuation versus bank valuation. Here, look, if you were buying bonds in between April and October of 20, which almost all of you were, the average yield on the 10-year was 65, 67 basis points. We're up 100 basis points. So everybody wanted that 100 basis point move. Are we happy? We're asset sensitive, so we should make a lot more money, right? Wait a minute. We're not. And the only area we're feeling any movement, and it's actually pain, is the fact that now in March 31, I have unrealized losses, right? Do I care? And I mean that sincerely. Does it matter? And if so, what types of protection can I put in place? Here's your decision tree. Before you start moving assets from available for sale to held to maturity, before you put on interest rate swaps to hedge the OCI mark, take a deep breath and go through this decision tree. I run this with all of my institutions in my advisory practice. How exposed is your institution to rising rates, right? And if you have up 100 basis point net interest income decline of more than 5%, or your economic value of equity or net present value drops more than 10% in that up 100 basis point move, you might have to execute a risk reducing transaction, i.e. shorten the bond portfolio, put on some, or lengthen the liability side, or and manage the interest rate risk position. Or some of you just tell me for some reason you believe, I don't, you believe it's better to be more asset sensitive. I would argue it's better to be neutral, but some institutions tell me they want to become more asset sensitive. Then you'd have to execute a risk reducing transaction. Now, if you say no to the first two, then I start going into what I talked about, my governor approach, the bank's TCE ratio, right? Or the credit union's tangible common equity ratio, tangible equity ratio, net worth ratio. Does it fall below 6.5% if rates rise 100 basis points? If yes, and you said no to the risk reducing transactions, you're an asset sensitive institution, you're just light in capital, then we start thinking about accounting solutions. right? Or in theory, if you're concerned about potential impact on valuation if TCE declines due solely to your available for sale portfolio, you say yes, that's an accounting solution. If you said no to all four, please do nothing and continue doing exactly what you've been doing, which is managing your balance sheet holistically. Here are some alternatives that you can look at if you're worried about the available for sale mark-to-market risk. Moving bonds from AFS to held to maturity, don't love it. I would argue if you've got a much larger bond portfolio than you typically have, take a look at historically where you've been on an AFS basis, and then anything above that historic number, then you might start thinking about moving assets to held to maturity. Be careful with CECL implications on non-agency securities in held to maturity. Looking to sell securities for a gain or a loss and to shorten up the asset base. Loss trades may make sense here with the yield curve steepening, so that might be something to think about. But in fact, to offset the loss you take, you may have to go out the curve a little bit, so you have to pay attention to what that would do. It may be counterintuitive. We've seen a lot of people swap their floating rate, their fixed rate municipals to a floating rate. You're giving up earnings with the yield curve as steep as it is, but you can do that. That trade works. And we've also seen institutions pay fixed on an interest rate swap on the liability side, or buy a cap, hedging short funding like from the home loan bank, or paying fixed on a swap to hedge short advances. That mark to market, because it's a cash flow hedge, will live in other comprehensive income and offset the negative move to the bond portfolio. My favorite slide to hand to that board member who's concerned that if you're at a publicly traded bank about the valuation of your company. I love to graph the mark to market risk here in orange. That's the mark on your bond portfolio, and here over time. And here is price to tangible book in blue. This literally works in exact opposite movements, right? If you go back to, let's pick a time in 2010, bank stocks were trading incredibly cheap, right? Because everybody was worried about credit. There was no loan demand. Interest rates were way down. Look at your bank bond portfolio, valued really high, bank not valued very high. Flip around, 2018, bank stocks were probably trading at their highest, almost, at least in the last 20 years. And bond portfolios were valued at almost their lowest in 20 years. There's a direct non-correlation between where your bank stock trades and where your bond portfolio would be valued. Okay, a couple other slides before I get out of your hair. Quickly, hedging trends. What are people doing in the derivative world? And as I always say, when you're going to go and work on an interest rate risk management play, you should have bonds, loans, deposits and borrowings and derivatives all in your toolkit. And I've always said this, and something that served me really well. Somebody said to me 20 years ago, Scott, you want to be a good strategist? Maybe 15 years ago now. Somebody said, if you want to be a good strategist, don't be a hammer. And I said, what does that mean? He said, when you're a hammer, everything looks like a nail. When you go to a company that only does derivatives, and you say to them, hey, I have an interest rate risk problem, what do you think they're going to solve the problem with? Derivatives. If you go to a bond shop and you say, hey, you're really good at bonds, can you help me manage my interest rate risk profile? I'm going to guess they're going to lead with bond ideas. Same with loan shops, same type of approach. That's why I think holistically is the right way to go anytime you're thinking about an interest rate risk play. And hedging can be on balance sheet hedging and derivative hedging, right? If you went out today and took out a 5-year Federal Home Loan Bank advance, that's a hedge. That's a hedge against rates going up faster than the market thinks, right? Or you can do it in swap form. So here's really the 4 big questions I've been getting. I do run our hedging business, and we had a record year in 20, and 19 was a record year. And I'd like to think it was because of how smart we are, and it's not. I'm very realistic. It's because interest rates went and changed dramatically, number one. Number two, the examiners have opened their eyes to how efficient the derivative market is. I go down twice a year and educate the examiners on derivative use and derivative transactions that are going to be on balance sheets. And so they've opened their eyes, and Dodd-Frank has laid a clear, transparent approach to it. And you know, one of the third reason, and probably the most important, the simplifications that FASB brought to accounting for derivatives. So all of those have taken a lot of the heat off of why people were staying away from the derivative world. Number one question I get, I paid fixed on a liability swap last year. I love the rate protection, but I don't need the funding anymore. What should I do? Well, a lot of institutions have unwound those swaps at massive gains, paid off the funding. When you use the derivative world, it makes it a very efficient market to unwind at a gain or a loss. You know exactly where it's trading every single day because you're marking it through other comprehensive income in this example. And absolutely something that you should explore if you've got too much funding right now and don't need the rate protection. Some people need the rate protection and potentially, want to amortize that gain over the life. It really depends on what goes on the underlying funding. That's a longer discussion that we can have on a one-off basis. Can I replicate this same pay fixed rate protection, but hedge using an asset instead of a liability? And absolutely you can. That's my example of looking at long dated fixed rate assets like municipals or like fixed rate loans on your books and swapping those to a floating rate. If liability, you go longer, the same thing on the asset side is going shorter, right? And so taking a fixed rate asset and getting short on the curve. I'm watching term rates rise, but the short end won't budge. How do I offset some of the earnings drag of my floating rate assets? This is by far, and I probably should have put this number one, this is the most popular transaction getting done across the country in terms of derivative use. This goes back to exactly my example of you need to understand the part of the yield curve that matters most to your institution. We've seen the long end of the curve ramp up. The short end hasn't moved. So many of us are tied to the short end organically and authentically, and that's okay. But now that we know that, what can we do? And what I've done is I've taken my least liquid asset. So instead of taking all my liquid assets, i.e. cash, and going as far out on the curve as I possibly can, which reduces, I'd argue, some liquidity, right? In theory, if I had to get out of it with a lot of duration, it can add a little bit of a hurdle. Why not look at my existing loans that are tied to LIBOR or Prime, right? And swap those to a fixed rate for 5, 7, or 10 years, add over 100 basis points of incremental earnings, and take some pressure off when I'm putting my cash to work in the bond portfolio. That is an incredibly popular trade because what it does is it reduces my exposure to the short end of the curve and moves me out across different parts of the curve. It's why I love derivatives so much, because it allows me to dictate the parts of the curve that I want to be on as an institution. And I don't bother my depositors. I don't bother my borrowers. And I manage my balance sheet in the treasury area. And I love that transaction. And it's one I'm going to get to in a minute. Here we go. I love, me, I'm not smart enough to do anything without boxes and arrows. Here's a great example of an institution came to me and said, I want to look at that receive fixed swap trade. And I'm telling you right now, first quarter earnings are getting ready to come out. You're going to read about a lot of institutions that have put a transaction like this on. One that's public and is out there and they filed their AKs already is Fulton, F-U-L-T, did receive fixed swaps, being an asset sensitive institution, so tied to the short end of the curve. They wanted to add some asset duration and do it in an asset that was less liquid, i.e. the loan book, picking up well over 100 basis points for doing that. And I'd argue reducing your exposure to the short end of the curve. Really have to understand what parts of the curve matter most to you. There are other types of hedging going on. A lot of us have public funds. You can buy an interest rate cap out of the money and hedge some of the exposure you have to that. That's a really popular transaction as well. And here's the third one. If you're exposed to interest rates, the short end going higher, or you're worried about the OCI mark, take a look at some of your long dated municipals and swap them to a floating rate, right? You're going to lose earnings, but it's a great way to take something on the long end of the curve and bring it back down to the short end of the curve. Again, has to matter about your balance sheet and what would make the most sense. But there is so much to do in the derivative world that you can help your organic institution out tremendously without disrupting and bothering your lenders. As I said, anybody coming in to look for specific loans, I've always said it is your lender's job to create interest rate risk. It's your job to manage it. And you've got all these tools in the toolkit to manage it. And you can tell here, I'm certainly not predicting interest rates because, in fact, I don't predict. I just prepare. Depending on the parts of the curve that matter to me, where they move, what are my next couple of strategy ideas? And so a lot of them will involve bonds, or maybe derivatives, or maybe loans, or maybe deposit strategies. And then, all of those should be on the table when you think about what you should be doing next. I want to leave you with a case study and then key takeaways. Adam and Tom, hopefully I'm not way too much over time here. Two final things. I thought this was important. This is a real live institution, a bank, $1 billion in assets came to me and said, Scott, I've got cash as a percentage of assets at 10%. My securities as a percentage of assets is 15%. And if I just take my cash and go from 10% down to 5%, that makes me feel good. I'll make a little bit more money, but I'm a little concerned that I'm not picking up enough earnings for the rate risk I'm adding to my balance sheet. I'm an asset sensitive bank, but I can't get my board comfortable going way out the curve and getting some exposure to the long end of the curve in the bond world. So what we decided to do is to say, look, you're asset sensitive, but you're only asset sensitive in a parallel shift, right? That's your first step. You need to know, are you asset sensitive on the short part of the curve? And this institution was. So then we said, okay, why don't we deploy 50 million of your cash? That'll bring your assets, cash to assets down to from 10 to 5. And we'll go way out the curve, right? Reduce exposure to the short end. And the board said, no way. I'm afraid of it. And this is a lot of us. I'm afraid of doing it, even though I understand your rationale. So what we end up having to do is give up some earnings, and I'd argue not reduce exposure to the short end of the curve enough. We decided to buy 80% of that cash into 20-year 2% mortgages, very pledgeable and liquid assets, right? Cash flowing, stable profile, and 20% in the non-agency CMBS in the 7-year part of the curve. That weighted average yield was almost 180 basis points. So we picked up a nice earnings stream, not as much as I'd argue we should have done in that 80-20 mix, because I think we needed more exposure to the long part of the curve. But here's what we did. We took 75 million of floating rate loans and swapped them to a fixed rate. This is my least liquid assets, taking the assets, swapping it from floating to fixed. And here's the beauty of this. This is a cash flow hedge. So I don't have to have each specific loan identified. I have to have a pool. And more importantly, I just have to have exposure to prime or LIBOR. Even if there's prepays in that pool, it's okay. And this institution was able to move out the curve in the loan world, right? Pick up 100 basis points there. And now all of a sudden we added 16 basis points of margin, improve the down rate environment, right? Because we pushed out the curve. And still we're able to make so much more money in an up 100 environment that we actually make an additional $400,000, even in up 100, even though I changed the volatilities a little bit. So I thought this was interesting because I was able to stay liquid and pledgeable in most of my assets I purchased. And I was able to take my less liquid assets, add duration on credit I already underwrote. I already understand. I didn't have to go out and buy assets I wasn't familiar with, right? And so I love this package trade because it reduced my exposure to the short end, incrementally added a tremendous amount to earnings, and reduced volatility in not only a parallel shift, but reducing the reliability of waiting for the Fed to move the short part of the curve up. There's a lot of you that look a little bit like this, and every situation will be slightly different. I encourage you to reach out to me. I'd love to walk you through thoughts and ideas based on your own institution. Here we go, and I'll open up to Q&A. Just my key takeaways. You're probably tired of me saying it, but I really believe in it. Know what part of the yield curve matters most to you. Small moves in rates should lead to execution. Don't wait for the parallel 100 basis point moves. The parts of the curve, the spreads, Fed funds in 5, maybe your 2s and 10s, maybe you're some other movement. When that moves 20, 25 basis points, what types of transactions are you putting in place based on that? Because you're either exposed or it's an opportunity. How to use strategically measure liquidity. You should better be able to answer that question. Hopefully I gave you the 30-second version of why derivative use is up. Everybody from examiners, investors, boards, all understand that derivative use can be really helpful and an efficient manner to measure interest rate risk and to manage interest rate risk. And 21 is a year that I think we're hopefully all dusting the cobwebs off, moving, going back into your closet and getting away from your sweatpants and back to your suits and finally putting pants on with a button, at least for me, at some point here. But 2022 is on my mind, right? 21 is this sort of getting ourselves ready. We need to be prepared for 2022 and understanding those 4 key points that I just laid out: liquidity, derivative use, small moves in rates, we're going to see them, non-parallel shift moves, and understanding parts of the yield curve will help you get better, not only for end of 21, but more importantly, I think for 2022. Pay attention to the M&A impact on cost of liquidity, not liquidity leaving, cost of liquidity. That will change as M&A starts to ramp up. So with that, Tom, Adam, I'm happy to take questions and try to answer anything if they're out there. Otherwise, I will get out of everybody's hair. I want to thank everybody for the time today, and really appreciate the Federal Home Loan Bank of New York inviting me here today.
Hey, thanks a lot, Scott. Yeah, it was a great presentation as always. We did have a couple of questions. We're running a little over time, but we have 2 questions. So the first one is it time to start buying up in coupons such as MBS 30-year 3%? What's your opinion on that?
Yeah, great question. I get it all the time. I kind of went from the 20-year 1.5s to 20-year 2s, and you're kind of saying the 30 years. 30 years make me a little bit more nervous when I go up coupon because they can go quickly the other way. I think in a silo, I would answer the question yes, but more importantly, what am I exposed to more in my overall balance sheet? An uptick in interest rates, then I would say yes. If it's a down move in interest rates, then I would say I'd be careful there because I don't want to have too much volatility in my cash flow stream.
Okay, Scott, thanks a lot. Appreciate it. Last question. Can you speak to what a community bank's duration should look like in this environment?
Sure. The duration should look exactly what your interest rate risk position tells you. And I will tell you this, if you're a liability sensitive institution, you're probably going to want exposed to, interest rates going higher. You're probably going to want to be most likely in the 1 to 3-year range, the 3.5-year range of duration. And if you're more the opposite, you do a lot better if short-term rates are higher, then I would argue your duration should be in that 4 or 5-year parts of the curve, maybe even a little bit longer. Obviously, depending on the 2 big indicators: 1, your interest rate risk position and part of the curve that matter to you. And number 2, that tangible common equity ratio for a community bank is important. Pay attention to movements in rates and what your available for sale portfolio will do. That'll help you, give you a really good guideline around where you should be in the duration portfolio.
All right, Scott. Well, that concludes the session for today. I really appreciate all your insights. It's almost 12 o'clock, so again, always a pleasure. I just wanted to mention, again, Adam had mentioned it earlier, we have another session coming up, April 22nd will be our next webinar. That'll be conducted by our in-house Director of Capital Markets and Research, Ray Shinazuka, and he's going to be giving an update on LIBOR transition. The title of the session is LIBOR Transition Fourth Quarter or Overtime. So he's going to be talking about some of the new milestones, some of the changes that have occurred, and then also discuss and offer insights on how to formulate and proceed with a strong game plan as we transition away from LIBOR. And so you come into the end result with a nice smooth transition. So that concludes our session for today. Thank you everyone for attending, and we will see you in 2 weeks. Thanks again, Scott.
Thank you.